Malcolm, how was your weekend? Did you watch the All-Star game? Winter Olympics?
I did not, because I spent Valentine's weekend. See, it's not just a day. I spent Valentine's weekend wooing my wife, and so I missed all of All-Star weekend.
That's very sweet of you.
It is, isn't it?
Yeah.
I hope she agrees. No, it was great though. We hung out in New York and just ran around the city. I mean, literally. So it was cool.
Nice.
How about you?
My significant other was sick over Valentine's Day weekend, so I spent that time discovering Jeffrey Epstein's swing trading account.
Which
has not been discussed on any other financial podcast. So that was my exciting romantic Valentine's Day weekend, Malcolm.
Is she equally as interested, and you kept waking her up out of her sick to tell her something else you uncovered, or were you just in your office with the lights off and everything in dark mode going down a deep dark hole?
I started to explain why he bought $300,000 worth of Yahoo stock and then immediately regretted it. But then I was like, we're not going to get into option strategies and mistakes right now. No, we're going to make up for it this weekend. All is good. But
allegedly that dude was terrible with money anyway, like according to people who work in the finance industry, which it seems like is like most of his associates, acquaintances, encounters. I don't know how people are classifying themselves these days to try and separate, but like it sounds like he wasn't any good with money anyway. So I don't necessarily expect he would be a good trader.
So that is what you have heard in terms of broad strokes, is that Epstein was bad with investing and didn't know what he was talking about. Mm-hmm. What you have not heard on other financial podcasts is exactly how he was bad at stock trading and bad at money. And that is what we are going to get into on this show. We have some listener questions and comments, including one trying to prepare for an AI bubble to burst, one comment from a listener in London, England that I'm excited to address. Let's get into it. Malcolm, I know from you going on CNBC, you always have thoughts on tech. And we've got a continued AI sell-off right now. People are moving into heavy assets and trying to get away from what was once a stock market darling. Before I do my deep dive into my Epstein rabbit hole and get on my, not even tinfoil hat, start going through the documents literally, anything in the AI sell-off you want to hit before we start getting into it?
Yeah, two things. One, so like you said, I was on CNBC last week. I'm sitting with Josh Brown, and he's trying to coin a new acronym, HALO.
HALO.
And I think he's trying to beat Jim Cramer to the next, FANG, because Cramer famously coined FANG, and for, 3 years or something, we were using that as our acronym before Mag 7. So it's focused on what is it? Heavy assets, low obsolescence, I think. Yeah. And I think I was the only person that day and probably that week who was in favor of going shopping amongst all of the software stocks that have recently sold off, rather than trying to move to like Caterpillar, John Deere, Raytheon, GE Aerospace, like all the really heavy machinery, earth moving things that you can look at and say, okay, well, this can't be disrupted by AI. In my mind, the moment we're living through right now, where the market overreacts to Claude Code has a new function that analyzes tax returns and gives you an analysis, or Claude Code has a function that analyzes risk in insurance policies or analyzes real estate leasing terms, or all of those different things are actually announcements that were made last week that sent the shares of LPL, Raymond James, Charles Schwab down because a private company, Altruist, showed new AI-related functions where it can help financial advisors analyze client documents, and none of those companies have that feature. So immediately, those companies are now worth nothing because this new upstart has these cool new features. Or immediately the stocks of the real estate management companies like Jones Lang LaSalle, for example, are down 10-12% one morning because Claude Code can now analyze leasing terms and give you a detailed analysis of whether a investment is worth it or not. Like, the overreaction that's happening right now to any and everything that looks like AI might be able to possibly have something to say about it tells me that there are opportunities to go buying companies that I was already wanting to own versus trying to move to the next thing, hoping that it can't be disrupted by AI, which means it won't get sold off. Instead, it'll get bid up. It just doesn't work that way.
Two immediate reactions to that. Number one is it is, I guess now is a reminder that you don't want all of your investments to be exposed to one single theme. And that's why I have some tech investments. I also have some a little bit in bonds. I have some in real estate. I have some in insurance. And that's kind of why is what has also allowed me to not panic about this reversal in story. And to give Josh Brown some credit, your friend, he's welcome on the show anytime. Maybe you two can argue about Halo, because I read his blog post about it, and he also points at some software companies like Toast is one that he highlighted, where here's a company that is growing a lot. They have basically an asset base in place, and it's difficult to believe that all of these mom and pop restaurants are suddenly going to get rid of their tablets for some AI upstart. Even though that's how the story is dragging down this company. He also
think about how long it took to get them to accept those terminals in their restaurants in the first place. Like, it was a 20-year slog basically to get those terminals into each restaurant that wasn't a chain like a Chili's or something. So now all of a sudden they're going to believe in an AI upstart overnight and be willing to replace their entire fleet of payment processors.
Yeah. And so I think to his credit, I understand Halo is a great acronym. There's also it's not just heavy machinery. He points at Toast. He points at Starbucks. I mean, I've come out in favor of Starbucks on the show, so I always like hearing people confirm my own biases. But
I mean, I agree with what you're saying about the diversification piece of it and wanting to have some eggs in different sectors and different baskets and whatever. But I'm thinking more specifically about some of the stocks that I already own, others that maybe I'll want to own if, it hits the fan enough, because for some of these companies, the valuation, the multiple still doesn't make enough sense. But I'm looking at like a company like Zscaler, for example, is just been obliterated. In my mind, it's not a software stock. It's like cybersecurity. Standalone cybersecurity companies are their own category in my mind. If agentic AI is taking over the way we're told that it is by the tech community, that means then, I'm oversimplifying, but what it means is I'm going to have to be comfortable turning over my machine, ownership of my machine, to a bot that is allowed to log in with my credentials on my behalf and execute tasks as if it's me. So doesn't that then mean I would need even more of the modules that a company like Zscaler can offer to make sure that the agent isn't going rogue and doing things on my behalf for my machine that I haven't given it permission or instruction to do? So that then means that Zscaler can add more modules, because this is a cloud-based, cloud-native AI software tool or company, platform, whatever word I'm supposed to use here, that guards against entry points that I want to have protected. So they now have pricing power in a world where everything is run by agents, because everybody's worried about the agents going rogue. So to me, it makes more sense that I'd want to own Zscaler now when it's fallen like $75 from its high, versus sell the shares that I own and move on to, I don't know, John Deere. Like, I keep using that as Caterpillar or, so that's more what I'm focused on. Is like, there's a huge opportunity being created here now because the market's overreacting in the wrong direction.
So just for context, I think you said it, for people less experienced in cybersecurity world, what Zscaler does is it's essentially a security guard. Often when you log in or try to go to different applications on a work account, something that I have dealt with, it is an absolute pain to have, because it constantly logs you out, and then you're like, all right, I got to do Zscaler 2-factor authentication. However,
that's what they refer to as zero trust. Like, every single time you leave the environment, you must log back in because we do not trust you.
Zero trust can last for 8 hours. I think I think we can have zero trust and then an 8-hour workday, and then we can go back to zero trust again the next morning. What's annoying is when I'm on the same Wi-Fi network and Zscaler starts to zero trust me 90 minutes into me working on my work computer with the same Wi-Fi network.
But you'll want it to be that annoying and that overprotective when there's multiple AI agents that have your credentials and you've clicked the little box that said, I agree and approve, and didn't read any of the 6 pages of terms of what you allowed this thing to do. And the only thing stopping it from draining your mom and dad's bank account on your behalf is whatever cybersecurity protection layer you've put into place.
I think that's a really good case. And there are times in the past where I've thought about when people or when investors panic about cybersecurity companies. Happened with CrowdStrike during the outage. And then if you're able to sort of see a longer term vision on this, you can end up doing quite well. So I'll put Zscaler on my watch list, and I would rank it likely that I'm going to pick up some shares within the next week or two. I think you've convinced me, Malcolm.
I thought that was it. I thought the show was it. That was all I came to do.
We're about to go down a rabbit hole.
Okay.
So do you just, as we get our snorkel and oxygen tanks ready, is there anything else you want to say on the current market? We will come back to the current market before we go down this rabbit hole.
No, I'm that was it. I think people are making a huge mistake. I think there is a huge opportunity being created. So in almost a year ago, in March of, I said no, and now I realize I do have one more thing to say. It was like March of 2025. I'm sitting at the New York Stock Exchange. I'm looking dead into the camera, and I'm like almost begging people to ignore the headlines and the nonsense that's swirling around us and the red that's on the screen, and start buying stocks of companies that actually have a real business and do a thing. Because these are the kinds of moments where fortunes are created. And people won't necessarily tell you that. They'll do everything they can to scare you out of investing, actually. But moments like these, when it seems like everything is being sold and like people are panicking, this is when you got to be greedy because others are fearful, and then get back to being fearful when others are greedy.
I think you have a new acronym. It could be RBDT or RBDAT, which would be like real business do a thing. That's something we need to get more publicity on this show. And I think an acronym, we can do another press release on a new acronym we've come up. You can do press releases about a lot of things. So I like that.
Well, there's 40 million ETFs now. We could create a RDAT ETF that,
great. I'm in. Let's do it. All right. This weekend, I have been looking. I've wanted to do some Epstein conversation on this show, Malcolm, but I've also not known how to do it in a way that's different from everybody else that's talking about it, because it's such a broad topic right now. It's something that the more I look into it, the more it just bums me out. I'm seeing a complete split in trust. I think it's hard to see how this open wound is reconcilable. And I've been going through some of the documents, and I ended up finding his swing trading account, for which there are some specific investing lessons. A couple of things that stood out to me just in terms of like pieces where I was just like, this is interesting and I need to get it off my chest before I get down into the investing lesson. Number one, Larry Summers having followed me on Twitter in his email signature, which I don't know if you've gotten that from people, where just in the media business where it's like, oh, I got an email from someone, and then at the end it's like, hey, make sure you follow me on Twitter. I just thought that was really thirsty for someone who is the former Secretary of the Treasury. Like, you've controlled all of the money in the United States, but we are telling everybody to follow you on Twitter in your email signature. All right.
It's possible he didn't set that up.
But here's the thing. I hear that. The T in Twitter was lowercase. So that's why my conspiracy theory on that is he totally set it up, because if it was a social media professional, they would have capitalized the T in Twitter. So nice try. I hear you. I'm moving on to the next one.
Listen, I have no idea one way or another. I just feel like Larry Summers, when he went into the government, was probably in his 60s. And I'm sure there's a staffer who is responsible for those kinds of things.
Maybe. Second one is that as I was looking through some of Epstein's stock trades, this is also where redactions make absolutely no sense. So there was a list of Paul Barrett, who was one of his advisors, saying which positions he should essentially stay in and sell out of. At one point, Epstein was almost equal weight in Budweiser and Microsoft, which I found strange. But when they were going through these list of transactions, the Justice Department redacted a specific stock ticker, but then left in the rest of the sentence, which was that this is an Amazon of China trading for roughly more than like $40 a share. And this was like 7-8 years ago. So you can take that clue pretty quickly and realize, oh, they're talking about JD.com. I have no idea why they're redacting this, but leaving in every single piece of information that allows me to find out what this is.
So here's a question. Is that because the person whose job it was to redact it didn't agree with the redactions and so they did the bare minimum, or are they just that incompetent?
I'm leaning towards the latter.
Because it's possible that there's an insider here who says, I'm going to leave some breadcrumbs so you guys can find it, but I still got to do my job.
That's also possible. It might have been like, hey, this is a foreign company that we don't want to create any association with, even though that's BS. And it's really just a stock that his advisor told him to buy. Much of what we're going to talk about is how there wasn't a lot of care and attention going on with these stock trades. And there's been a lot of coverage on the deep web of financial connections that he had. But what I found from reading this is a lot of it is just, it's gut reaction and short-term options trading. So there's some emails between Epstein and his advisor, Paul Barrett, where at one point, Epstein just gets really mad at him because he said that his advisor would reach a trading target and then move the target and then lose money. And it wasn't people who appeared to be trading with a information edge, I'll say. For example, there's one where they're arguing about Broadcom because Broadcom made an acquisition that didn't make sense and they wanted to buy put options as insurance on the company, but it was just a short-term thing. And as I was reading this, Malcolm, I'm like, these are less masters of the universe and more people arguing on Reddit with millions of dollars. And I think that is what's been the most surprising to me, because I'd heard the narrative that Epstein was really bad with money. But number one, with all of this stuff, I don't know what to believe, because I wonder if that's CYA behavior. I always knew that he was bad with money and that's whatever. But it turns out, no, he actually was. And I saw some fundamental reasons why. And moreover, what I would have expected, and maybe these emails are not there, is that for someone who is interacting so frequently with leaders of industry, government, people who run nation states, I would have expected to see some sort of information edge in his trading activity, even though it was just his swing trading account where he's going on gut.
I think you got to go to Congress to get that inside edge.
Yeah.
Like, I think if you really want to be an insider and you want to have a 100% chance of this trade paying off, you got to work your way into being an elected official.
But some of those people allegedly may have been at the island. They're not giving him, he had a very specific strategy that he's implementing in his swing trading account. And this is from, that's what his advisor said. And then this is what he was actually doing in his account, which was a $4 million account. Before you say that's nothing to a guy like Epstein, what I would say is he was making about 11 trades per day at one point. So clearly this is something where he was spending a lot of attention on it. And his overall strategy was buying out of the money call options and margin bets on very strange turnaround stories. Radio Shack, JetBlue, Aeropostale, Yahoo.com. And it seemed to be what he was doing is he was constantly trying to be a contrarian with these short-term bets. Many of them didn't pay off. And he ends up losing $1 million over the course of a year on this trading account. And then essentially rage quits, withdraws all of his money, and then mysteriously puts in, another $1 to $2 million right before he goes to prison or jail for the second time for a few days. But what I thought was so interesting in this, Malcolm, is that he was constantly trying to be a contrarian, struggling retailers, airlines, beating up energy stocks. And that's how you lose money, because he was right a couple of times on this, But many of the options expired worthless. And in doing so, he thought he was thinking differently from everybody else. But in reality, sometimes the market is mostly right. It's really hard for Yahoo to turn around. It's really hard for BlackBerry to turn around. And he was pretty consistently wrong about that.
So to the last point you're making there, that's a classic mistake that I think a lot of retail traders or individual traders make, which is that they assume that because something has been beaten down significantly, that means it has to come back. Everyone else has to be wrong about this thing. It has to be coming back. And what I think is the better way to frame that approach, because I have done well investing in companies sometimes where, like CrowdStrike, for example, you mentioned them earlier, like when they had their sell-off following the outage that basically brought corporate America to its knees for an afternoon, like to me, that was a thing where it was a snapshot in time. This is a company that there is no alternative. The switching costs are very high. Yes, you'll be pissed off, but you're not going to leave. They'll probably lose some money making you happy and apologizing and going on an apology tour. But 6 months from now, we will have moved on and this company will start to regain its footing. And so, it sold off, I don't know, it was like 30 or so % in one day following the outage that happened over the weekend. That's a place where you can look and say, like, fundamentally, not a lot has changed about this company. Yes, they had a mistake. Yes, it was huge and public, but the company itself is still the same company you loved 48 hours ago. You can't necessarily say that when a company has taken 5 years to run that plane into the ground and say now is when it's going to turn around. And Intel, I think, is a great example of that. I made the mistake of buying shares of Intel thinking Pat Gelsinger was going to be the thing to turn it around, not realizing that culturally it takes a lot more than just that one CEO who's also a long-term insider to really right the ship here. And so I think that's the classic mistake that a lot of individual investors will make, thinking that this brand that's been around forever has to continue being around forever because it's been around so long.
I think, and I'm going to get back to the story, there's also a tendency in there. Pat Gelsinger was telling investors all the right things. And there's a tendency for individual investors to say, one of the things I do is judge management teams. And I think in reality, the same way one can think I can judge how good a sports team is because I got, this is the eyeball test. I think that's significantly more difficult in the investing world, where you're really only seeing maybe part of a PR discussion, carefully vetted talking points. And it's a lot more time and energy to not only know the CEO, but also what is this mess that he or she is trying to clean up.
And usually it's a person from outside of the house that can come in and turn things around like you want them to. The person who's been at the company for 25 years, 30 years, and is now succeeding the CEO who was here for 25 years, 30 years, is likely to break a lot fewer eggs because they agree with a lot of the things that were done in the first place. They all are kind of reading from the same playbook. And so you'd much rather have a brand new person who looks at it with fresh eyes, wipes the slate clean, and starts over.
I mean, there's a political comparison here, and it's not just one party. Very rarely do you get a vice president who goes on to be as successful of a president as the former president was. In places where you want that type of continuity, if you hear that the next CEO of Costco has been there for 45 years, you're like, yeah, great. I want this to keep on keeping on.
Berkshire Hathaway.
Yeah. When you want to turn around, that's when it changes. I'm going to go back to this trading strategy.
Sure.
Because the mistakes he made appeared to come from a place where this guy is extraordinarily rich. He's not doing anything productive with his time. He's bored and understimulated and is consistently losing money in short-term options because of that. One example of this that I found was in June of 2014. He bought 100 call options on Yahoo that expired in less than a week. The problem with this is he could have just lost the premium. These were a little bit out of the money. However, the options then expired in the money, so I believe they were automatically exercised and he bought the stock. So now he has about $340,000 in Yahoo stock, which he does not want. And then a few days later, he panic sells all of it for an $11,000 loss total. So it's one of those things where he was trying to essentially be his own hedge fund manager, but he's not paying attention to it like a professional money manager and is therefore making these sloppy mistakes like that.
That's why you hear me say a lot of times, I'm not a trader and I'm not good at it. Or the other way around, I guess. I'm not any good at being a trader, so I don't bother to try and trade. Because if you're not a person who is sitting fixed to your screen at all times, watching as things happen throughout the course of the day, you have no business swimming in those waters.
To wrap up, the most surprising thing was, I know he was bad with money or bad at trading. And maybe he was early in Bitcoin. There were other investments he did that worked out. What was the most surprising to me about going through this is I was expecting sort of one great trade to make up for these losses, for the amount of people that he's talking to and dealing with. And looking through his trading account, that was completely not present. And I think that's what was the most surprising to me. You can have lots of people saying that he was bad at money, but he's dealing with so many of these highly powerful people that I would have expected that to show up maybe once in his trading account, and it didn't. So anyway, that's the end of the rabbit hole. Let's get out of the rabbit hole. I know you have. Do you want to do octogenarians in Congress? Is that something?
Yeah, I guess on a unrelated note, let's make that pivot.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
So this is a bipartisan issue that you're also concerned about, which is that now Rahm Emanuel, who is running for the Democratic ticket for president, is interested in instituting a 75-year, essentially, age cap on Congress and saying once you get past that point, you got to leave. And immediately he's facing pushback. I'm excited to hear your investing angle on this, Malcolm.
Well, hold on. Forget the investing angle for 2 seconds.
Sure.
Rahm Emanuel is a name we've known. I think he was the governor of in Illinois or the mayor of Chicago or something. Where's he from?
He was the mayor of Chicago, I believe.
So he's been a name. He's been around for a very long time in politics. And so now he's saying we should put an age cap on who gets to be president, but I want to run for president. And what I'm worried about is Joe Biden already pulled that trick on us and said, I'm going to be a one-termer, guys. Don't worry. I'm going to usher in change. I'm going to bring all these young people to the table. And then once he got there, he said, you know what? The view is pretty nice from the top. I think I'm going to hang around a little longer. And I don't know that I trust anyone else ever, no offense, Rahm Emanuel, to make good on that promise either. And so I hear you. That aside, I have been saying for a long time that we need to have caps on age in elected office. We need to have term limits. I don't think you should be able to serve more than two terms in whatever position it is. And I also think you shouldn't be allowed to be president older than 70. And that's not meant to be discriminatory against anybody who's 71 years old. But what I mean is I've yet to meet a 70-year-old who becomes more open-minded as they age. I've yet to meet a 70-year-old who has more energy as they age. And I've yet to meet a 70-year-old who's willing to break into new forms of technology and everything else that's happening culturally as they age. And so in my mind, we should be promoting the people who are mid 50s, who've got 3 decades of experience, but also enough energy and vigor to them to really work hard, fight hard, push through whatever the thing is. We've seen like how much of a toll this job as president takes on a person. Like think about some of the younger presidents and what they looked like after one term was over, right? So I think it starts there and it works its way all the way down. I think Congress definitely should have term limits. I don't think you should be able to die on the job at 90 something years old. What's the lady's name from Feinstein? Yeah, the lady that's living in the critical care unit for like a month, and her staffers are hiding her, and then we find out that she's basically in hospice. Like, none of those things should be possible, in my opinion. And the reason that we help make sure that they don't happen is by putting an age cap on when you get to sit in these seats. And it also opens up the field for the election cycles, because Joe Biden ran for president like 80 times and didn't win until the last time when he was about to be like 80 years old. And so what it would allow is for someone else to come into the fold, because you now are aged out of being allowed to run for that thing anyway. And so now we get to see new faces, hear new names, and get new ideas. And, it starts to reflect the populace a little bit better, because the average age of people in Congress is not at all the average age of the United States. And that is also a problem.
I hear your nonsense. On the flip side, you have Judd Gregg, who is a 78-year-old New Hampshire Republican who has served as governor in both chambers of Congress. He said to the Wall Street Journal, quote, "It's the world's greatest retirement home. You go there and do very interesting things instead of playing cribbage or backgammon or golf," end quote. And he also points to just the length of time it takes to get up to speed on this stuff. For him, he said, "It took me about 10 years to really learn the budget, Malcolm." This is something that,
I rest my case.
I think that, I think best of luck with this. If you cannot get a insider stock trading ban in place in Congress, best of luck with an age cap.
I think the insider stock trading ban will come. I actually think there's enough bipartisan support from those Congress people and senators who either don't have the resources to make it big on any of those trades, and so their feelings are hurt because they're on the outside looking in, or the people who have already made enough money that they can get on the right side of this and start making some noise and say, yeah, we should go ahead and close the door on this. Like, Nancy Pelosi has made a ton of money being in the right place at the right time where it comes to a lot of these trades. Nancy Pelosi was also wealthy long before the whatever the ticker handle, the Twitter handle was for Nancy's trades. Like, so a person like that has no reason to oppose a ban like this. Like, yeah, let's do it. So I think it actually does have some legs because it's got bipartisan support, because in our K-shaped economy, it speaks to both sides. Like, I think we really could see this come to fruition.
All right, I'm going to be more pessimistic than you for two reasons. Number one is what we mentioned earlier, which is options. Even with a little bit of money, if you know a certain piece of legislation may be getting passed that really benefits a certain company that people aren't thinking about, you can make an extraordinary amount of money through options trading, which members of Congress are allowed to engage with. I think there's the saying that, what is it? Good people come to Congress and then they get corrupted. I think that many people go to Congress with the right intentions, but absolute power corrupts absolutely. And that ends up happening to a lot of people, even if they come in with, right or left, seemingly pure interests into one of the chambers.
So we have people in the firm who are, I believe it's called senior executive service level people who are off the GS schedule as far as like their income wise and their job role, title, all that kind of stuff wise too, who are only allowed to own ETFs and mutual funds. Why are we not able to use whatever the legalese for their roles and just extrapolate that out and throw it at Congress and say, like, these are your new rules? Like, we don't need to worry about throwing in options and crypto and whatever and naming it specifically by name, because obviously, to your point, they'll just keep creating little fractals of how they can play it and still be within the only things you are allowed to trade: ETFs, mutual funds, anything you don't have direct control over. It's not direct oversight. It's publicly listed and it owns a basket of things instead of you being able to own the one individual Palantir that's about to go to the moon because of some government contract and getting announced.
Okay, so the actual the fundamentals of this is members of Congress are more likely to trade stocks on committees in which they sit. So committees in that industry. So they love trading stocks, Malcolm. And you're also, I think you're making there's a logical hole in that where you're saying there's this omnipotent power that is telling members of Congress what their new trading rule, this is what your new trading rule is. What I think is there is a power there for, let's say you're a young freshman congressperson. And you say, I want to ban individual stock trading in Congress, and you go on the cable news shows and you write up a bill and you introduce it. Then you get a phone call from one of the older members and you go to a table. There's about 4 or 5 of them there, and they go, hey, we really appreciate your tenacity. We really appreciate the great work that you're doing in Congress. And, you're really making a name for yourself, and we think you're doing a lot of good things. The congressperson says, thank you. And they go, the stock trading thing, it's not going to happen. Pick another issue. You have a bunch of other issues. It could be women's health, immigration, healthcare, or we're gonna hang you out to dry, and you're not going to be on any committees, and you won't have any power. This is the issue you need to drop. So we're going to work together, but this is one that's out of bounds, and we appreciate you learning the rules of the road.
So the deep state wins again, is what I hear you saying.
Deep state wins again. That's exactly what I'm saying.
Remember, I think it was 2015 when, it was before the 2016 election, and the MAGA base at that time, the rallying cry was drain the swamp. You're basically telling me we've filled the swamp.
I'm saying the swamp has always been there. The swamp is forever. How did draining the swamp go, by the way? Let's get into anything else on this. I know sometimes you always have thoughts, but we have some questions and comments that I want to address.
Only that I want it on the record that I am more hopeful than you that the 2026 and 2028 elections are going to bring down the average age of elected officials in Congress and the Senate by a wide margin.
I agree with you. I don't believe there will be a law passed on age limits.
We'll get there.
Okay.
I don't necessarily think that it'll be on the ballot in 26 and it'll win. I think that within the next 4 years, we get there.
And I actually do have one investing angle on this as we close out and go to listener questions and comments. That feeling of no one else can do the job like I can is often why you see CEOs with high ego end up putting someone in place with who are slightly less capable than them.
Are you talking Iger Chapek?
Iger Chapek is an example. Jack Welch was another example of that, where you end up there's a belief where it's like, I see myself as a godlike figure, therefore no one can ever replace me. So I deliberately find someone who is slightly less competent than me to do the job. And this is something that happens in corporate America. It's also something that happens in politics. If you think of sort of like turtles all the way down, where if you're the president, you don't want a vice president who's going to outshine you. So you end up having Obama picking Joe Biden, who they didn't get along super, super well by the end of the 8 years. You have Biden picking Kamala Harris, then picking, that's how you end up at Tim Walz, basically. It's just a series of powerful people trying to find someone who won't necessarily outshine them.
Yeah.
Anyway, let's hit these comments and questions. There was an investing angle at the end of that. We have a question from Pierre in France. He tells us, I'm listening to your new podcast every week. You need to explain how to bet for the AI bubble burst. Grok made some recommendations, but I'd like to know yours or Malcolm's. I trust you on this. And before we address this question, quick disclaimer, we cannot give personalized advice. This is generally how we are thinking about the question. You want to attack this one? I know you have a lot of thoughts on it. I can go.
I do and I don't. I think the question itself is flawed for a couple of different reasons. And I don't mean that to be disparaging at all, but I mean it like constructively. I think generally the thing that we are all paying attention to the most is never the thing that ends up doing us in from a market correction standpoint. Like the thing that we're sitting here talking about right this moment, unfortunately, probably none of the things we're worried about will be the thing that actually brings down the market. So trying to figure out how to profit off of the AI bubble bursting probably won't work out the way that profiting off of whatever the thing is that brings down the market will. But I'm not a short seller, so I don't look for things to short. So I can't even tell you where to find the opportunity, there. But I also think this is where people end up losing a lot of money and end up with a lot of opportunity cost lost. Because instead of trying to find the perfect way to play the bubble bursting, I think it's a better idea to be planning what you're going to buy when it bursts, right? Like, what do I want to own so that when the correction happens and then it starts to go back the other way up and to the right, I am perfectly positioned at the very right time to capitalize on the trade the most.
I think that's fair. And I think there's two ways that this question breaks down. One is, how do I make a speculative bet on the AI bubble bursting in the next 12 months? And what we've talked about previously in this show, it's very difficult to bet on narrative changes over short periods of time, which is what the options were previously. One way to do this, if you want to get greasy with it, you buy some put options on smaller AI companies that do not make an operating profit, that cannot make money doing the business that they're in. I found a few of these. They're not hard to find, but I'm also not confident that this is a good idea. The reason I would say consider the put option over shorting is because with a put option, the value can go to zero. With a short, your loss is unlimited on the other end of it. However, I think you're exactly right. One of the things that I've done is I've had a little bit more cash on the sideline than I've normally had before as I've seen this grow, because I want to be ready for those opportunities, Pierre. What Malcolm does is he essentially trims his losers and moves them into positions that he's more confident in. Now, if the other question is, I'm not trying to make a speculative bet, I'm trying to set up my long-term future savings to withstand a correction in artificial intelligence, I think that is one where, owning more ETFs that maybe are a little bit more equal weight in the S&P 500 could be something worth considering. Companies in non-durable goods, companies with optionality, like John Ratansi has discussed with us on a previous show. But all of this is to say, the reason you are diversified is so you can benefit from being wrong and right. And that's kind of how I would think about this question. All right. There's one separate angle on this, Malcolm, which is that you're a financial advisor in your day job, not just a podcaster and CNBC contributor. Are you interacting with people who this is affecting the professional advice community? I use LLMs for research and analysis all the time. Is this something you're interacting with where clients come in and they say, I've heard what you have said. However, I've put these recommendations up against ChatGPT, Claude, Grok, and I want to address the discrepancies there?
Forgive me. I'm laughing because my first reaction was, I wish they would. My thinking is really like, I'm glad that our clients have better things to do. Is in all fairness, and I mean that in all sincerity and with the utmost respect. I'm glad that our clients have better things to be doing than to backtest our investment recommendations against what an LLM tells them, because I don't use LLMs for any investment related advice and decision making, because there are still so many places where it can get it wrong. And also context matters a ton. And one reason that I am confident that the bots can't take my job anytime soon is because context is like 50% of the recommendation. And no matter how many things you tell it, it still can't quite contextualize the difference between a person whose first priority is, we want our kid to be able to go to college all the way through law school, medical school, PhD if they want to, and that is the thing we prioritize with our money above everything else, versus the person who says, I'm going to die with zero and the kids will have 12 pennies if I just happen to get it wrong, but I'm going to spend through everything I got. And knowing those kinds of things is the context that all of the decision making and the recommendations go through anytime we talk to a client. And I just don't think the machines are capable and will be capable anytime soon of having those kinds of nuanced conversations with people. But to your point specifically about the investments too, there's a lot of elements that go on emotionally when you talk to people about investing that I don't think that the robot can get there the way people hope it can.
Yeah, I think I've used it in the way Pierre does, which is, can I get some ideas based on these factors? And also for synthesizing information, I think it's not, maybe it'll get there someday. It's not good at understanding all of your personal context that you're not immediately telling it in that chat box. However, if you're looking for, Grok, especially, we've talked about this, like trends for what's going on in earnings, or, I want you to help me identify businesses over the past year that have seen large insider stock purchases, where executives are buying on the open market relative to the market cap. So, a $1 million buy for a company that's worth 10 billion is significantly different than a $1 million buy for a company that's worth $1 trillion. So that's something where I think LLMs are particularly useful for investing, is that ideation phase, but it's still up to you for context and for pulling the trigger.
So adding one more thought to that, I think investor...
You've always got one more thought, Malcolm. I'm ready to move. I'm like, maybe we're moving on in the outline, and I see it in your eye. You're like, maybe we are as well. But then you've got that one more thought. Go ahead. What's your one more thought?
Every investor should have an investment policy statement. And I think the LLM's job could and should be to help you stay true to that investment policy statement. So I, for example, have a 3-year time horizon on any investment that I buy or sell. And so one of the last questions that I ask myself is, will I regret not owning this company, this thing, 3 years from now? And if I'm not pretty certain the answer is yes, then I don't need to buy it right now. If I'm pretty certain the answer is no, then I'm good to sell it. And I think having whatever your 5 to 10 rules are baked into an LLM, and then you run your ideas and thoughts and everything else related to investments through that filter each time you're deciding, is helpful in that way.
I think that's really useful. I hope people...
You didn't want me to get my one more thing in there, see?
No, I don't think it's one more thing. I think it's funny where you're like, I just have a few thoughts on this. I say something and you're like, oh yeah, but the thing I really wanted to say was what I'm about to say. And then usually it's something very insightful. I'm grateful for you sharing it. And I'm sure our 3 listeners who are still listening, including one in France, are still benefiting from that. Love getting questions and comments. One place to do it is our email, thistimepod@gmail.com. Spotify comments work. We'll even take I'll take a comment on TikTok if you want to talk about the show. Sometimes I'll check that. And that is where we got a comment, Malcolm, from a listener who I believe is in London, England, but he travels regularly. His name is Scott Galloway. And he said, thoughtful conversation about our resist and unsubscribe segment. And for those who don't know, Scott Galloway is an entrepreneur who I believe enjoys podcasting as well. Of course, all right, now I'm speaking seriously. Scott Galloway is interacting with the show, Malcolm. Of course, I'm like, come on down to Podcast Town. I know you're probably doing 30 of these a week.
Sure.
Let's see if we can carve out a half hour for this resist and unsubscribe conversation. He respectfully declined the request, or I should say, someone on his staff respectfully declined my request. We will get there. Resist and unsubscribe, for people who don't know, is a movement stemming from Scott Galloway that is, I'm so upset with what the Trump administration is doing in the response to that, is telling people to actively not participate in the economy, resist and unsubscribe from your big tech services, which include Netflix, Paramount Plus, your ChatGPT account. And in doing so, this wave of unsubscriptions will create a ripple effect in the market that the president will have to pay attention to and then tell ICE to chill out. And we talked about it in what he described was a thoughtful way. And I really wish he would come on the show, because I think there are still some open questions that he may want to address, such as Malcolm, Uber is on the list. And I'll I'll credit my wife, Sam, for this. She said, isn't it a little strange if you're trying to help immigrants to tell people to not use Uber when much of their driving force is comprised of immigrants? I think those are questions you may want to think through if you're doing a resist and unsubscribe movement, or what the day after looks like. What is the end stage plan for resist and unsubscribe? What is, usually protest movements, strikes have a specific ask. Mm-hmm. And I cannot tell what that ask is other than vibes from what I've heard about this movement. So, Scott, call it a challenge, call it an open invitation. We'll give you a thoughtful conversation. We're one of the only podcasts outside of your universe actively spending time on the resist and unsubscribe movement. Would love to have you on the show.
Well, I did hear from his own mouth to Kara Swisher, his co-host, on one show, that the part of the goal in this was he wants to be part of the fight. Like, I don't necessarily care where I land, in rank of importance and everything else. I just want to be part of the fight. Like, I feel like I've been on the sidelines making noise for too long, and this is a way that I could think of to be a part of the fight. So maybe ultimately what happens is there's a big pivot that comes where initially the focus was resist and unsubscribe, but now after putting it into the market, I threw out my MVP to see if there's product user fit. And now what I'm recognizing is people like part of the product, but they don't like the whole thing. And so it's time to go pull out that one piece of Flickr that could ultimately become Slack. And that maybe is what we end up with.
I think it's also interesting. His career was built around understanding big technology platforms and telling people how to use them in consulting work and marketing work. And now it is telling people, I'm fed up with these big companies. It's time to leave. And I wonder how much of this has actually nothing to do with the political environment, but just sort of maybe a reversal on how he feels about big tech companies as he's sort of sat with that knowledge for a long period of time.
Yeah, I think it's a big idea. Has the right goal in mind, I think. Probably needs a big pivot.
I think you pick one. This is my last thought on it. You pick one. Is most intelligence analysts will tell you, you do not want to open up a multi-front war.
As the president of the United States, who opened 90 tariff wars on the same day, will tell you.
Is Scott Galloway making the same mistakes as Donald Trump did on trade with his fight against Donald Trump? That is a great question, Malcolm, and why this challenge stands. Come on the show for a half hour. We'll give you an interview you're not getting on the other shows. It will be respectful. It will be thoughtful. And you know what? I bet you get some clips from it that go viral. How about that? That's my offer to you. That's all for this week. Appreciate you listening to the show. I'm at Rick So Slick on Twitter, Ricky Mulvey on LinkedIn. Malcolm is at Malcolm on Money on social media platforms. But if you didn't listen to any of that, one thing that really helps the show is by leaving a comment or a rating wherever you listen. It really helps us grow this show and do more with it, because we like doing this show, and hopefully we can spread it to more listeners, especially if you have found value in it. Thanks for listening. That's all.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be, a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.